US stocks rallied on Tuesday amid optimism towards a potential fiscal stimulus package worth $748 billion. Apple, meanwhile, gained 5%, lifting the Dow on a report from the Nikkei, which said that the tech giant will increase iPhone production by 30% in the first half of 2021. And also lifting market spirits was that the US regulator said that Moderna's vaccine was safe and 9% effective. So lots of news there buoying the markets on Tuesday. Will that extend into Wednesday's session and beyond? Joining me to discuss is Serge Berger from thesteadytrader.com. Serge, great to chat to you as always. Now, in terms of US stocks, clearly we are coming off the back of a very strong November and a pretty good start to December as well. The major averages a whisper away from those all-time highs. Give us a sense of what we should expect as we head into this lower volume period around the holiday season.
Sure. Well, thanks for having me, Victoria. I think if you look at the market through the lens of seasonality, there's actually quite a strong, maybe a very strong seasonal pattern. And I brought along a chart here that essentially maps out what the S&P 500 has a tendency to do during fourth year presidential cycle years, which is the one that we've had this year. And this tracks the S&P 500 all the way back to 1928. So it's a lot of data. And typically in those kind of years, what you tend to see is if you focus on those green bars, you tend to see a pretty good rally in the summer months, then fairly lackluster to down September and October, all of which we've had. Then a strong November, which we've had, and now potentially a strong December. So I think if this were to hold true, and again, it's more or less held true very closely since June, I would not be surprised to see more upside into year end. To give you an idea of what this looks like a bit more closely, just literally November and December seasonality. This is literally just I'm going to make this a bit larger, literally just a couple of scribbles, but the lines here to the left of the middle line is November. So you can see a strong second half of November is typical. And then December tends to also have a backloaded performance month. So far this month in December, we're quite flat in indices. So we would suggest that if history's any guidance, we see more upside there. Question, of course, is how much upside? And of course, we're talking about a very short-term time window of a couple of weeks. Bearing any stuff out of left field, any unknown unknowns, which can always happen, I would not be surprised if we see the S&P 500 close the year anywhere between 3,800 and, as a moonshot number, just to give you one, maybe even 4,000. Not my base case, but I think from here, I wouldn't be surprised to see 3,800 or so, which is 34% higher from here.
So looking further ahead, what are you expecting in terms of US equities as we head into 2021? Do you think we should be bracing for a pullback, or are we heading towards all-time highs once again?
I think we could see all-time highs in the broader indices, the S&P 500 at some point next year. I wouldn't be surprised the S&P rallies another 5% next year, maybe a little bit more, but just because we've really had an economic reset with the pandemic. But our base case is really, if you look at the next few years, and this is not just 2021, but really probably the next 5 to maybe even 10 years, is that the broader index, the S&P 500, is going to underperform the average stock. And that we're going to see that the high flyers, particularly the mega cap names, the Amazons, the Apples, the Microsofts, even the Googles, going to be underperforming the broader equity market. So what we're really looking for is for a resurgence of the average stock, which we could also look at as kind of like more the value related names, which are sort of cheaper on a traditional valuation basis.
Yeah, we have heard a lot about this potential shift away from momentum towards value. So what are some of the opportunities, say, in the US or even Europe, in terms of sectors? What are the sectors that are likely to be playing catch up next year?
I think anything that's related to GDP growth. So to me, really, it's the financials. In the US, you can look at something like the XLF ETF, or in Europe, you look at the SX7P is the index for that one, which is the banking index in Europe. I think the banks could do quite well going forward, they've obviously fallen out of favor for many years now. But I think that you could see a catch-up period there. I think you could see catch-up in parts of energy. I think you'd see catch-up in consumer discretionary, and really get anything that's a bit more value-oriented, away from the mega cap growth stories that we've seen, which is not to say that we can't see growth pockets. Of course, there's going to be growth pockets in technology that do very well, but really, I think a more lackluster performance out of what you say the mega cap names is likely, in our opinion.
So in terms of some individual stocks now, Tesla gets set to join the S&P 500 next week. Pretty exciting story. But the stock is already up almost 700% from the 2020 lows. Surely this pace of growth is unsustainable.
Yeah, I mean, you and I have been talking about Tesla for the past 2 years together, I believe, and every time we talk about
Yeah.
it, it's sort of a chuckle, and not in a derogatory way. It's just a very bifurcated shareholder base. There's the people who love it, and there's the people who really don't love it at all, and quite the opposite. So, I think any traditional value here metrics doesn't make a lot of sense, and I have these conversations around this name with clients and internally literally every day. However, we're getting to a point here with Tesla where we think we could be at a critical spot, at least for sort of a 3 to 6 month period. And there's two reasons for it. Number one, we are getting to obviously the S&P the stock getting included in the S&P, although some people probably think it's the opposite. But anyway, so that could potentially put a cap on the stock for the time being, as this news has really been front run. People have been buying the stock in anticipation of that, because as portfolio manager, indices have to buy the stock. So I think, maybe you see one last pop next week when the stock actually does get included, but maybe then it's done for a while. The other thing, and this is more of a 2021 story going into maybe the second and third quarters of next year, is the potential of Tesla to merge with another big automaker. There's a lot of reasons for that to think about that, in terms of why and how it's so difficult for traditional automakers to do the assembly chain that they usually do, which is really more car assembling than manufacturing, because everything kind of fits together. But it's very different with a battery, motor, and GPS and all that stuff that they have to come with. So that's something that we can discuss probably deeper into 2021, maybe second quarter or so.
What about Apple? I mean, the stock's been rallying this week on the Nikkei report that it plans to increase its iPhone production by 30% in the first half of 2021. I mean, firstly, have you been surprised by the impressive recovery from stocks like Apple and other tech giants this year?
Well, I think the pandemic has probably brought forward returns for a lot of these companies, and I think this is somewhat true to Apple, probably more so for something like a Peloton or a Zoom, which were really got a boost from this whole thing. But I think, really getting back to the earlier point, as great as Apple as a company is, I think there's going to be an underperformance in these types of names. Now, there's an ecosystem, and I literally just got this brand new Max phone, or whatever it's called, and it's amazing, and the ecosystem is just tremendous. Nevertheless, if you look at the numbers, if you look at the actual growth in iPhone sales, where there's a lot of margins, and it's somewhat difficult by our math to get to previous growth rates with just the services business alone. So we could see the stock go higher. We're actually currently long the stock in full disclosure from a trading basis, but I don't think it's going to be the growth story over the next few years that it was over the past few years.
So in terms of the Apple chart, give us a sense of what levels we should be looking at. What kind of resistances on the upside should we be eyeing?
Look, in the year end, you have dynamics of global of asset manager, what I call performance anxiety, where they have to essentially chase the charts to justify their jobs next year. I wouldn't be surprised if we tickle the all-time highs again, 135, 136, maybe 137 to be, not to be too exact, but I wouldn't be surprised if that happens, but that's literally just a trade. We did have a lot of buyer exhaustion there in September, but I think that's a logical upside target from the here and now that gets us another 4 or 5%. I might play it a bit closer to the chest. They'd be calling it 132, 133 as an upside play. But I think after that, you're starting to there's a lot of overhead supply around the all-time highs. So I probably wouldn't try to chase it beyond there in the near term.
All right, and just very finally, switching tack to Bitcoin has been a very interesting play for investors lately, and now we're inching closer to that $20,000 mark. Do you see this resistance level being taken out, and what are you watching on the chart?
Yeah, again, another one that you and I have talked about now for the past few months.
Yeah.
And look, the underlying story in Bitcoin has certainly changed, and I'm not the only one saying this. Plenty of people out there that have woken up to this over the past, let's say, 6 to 12 months, is that the institutional base, and we see this talking to our contacts and our clients, they have woken up to this space. They're buying it, whether it's outright or even some of them through ETFs or all sorts of structured notes or whatever people are trying to do, and total return swaps and whatnot, but they're gaining exposure to it. So I think the bid here is real. It is important to understand that this is a volatile asset. So if you're going to allocate to this, I would say two things. First of all, allocate, not too much, because it is volatile. So volatility is in itself is an asset allocation, if that makes sense. And secondly, is just the fact that really this is, at least in our view, not a trade, but an investment that we're looking at through the lens of a number of years. I wouldn't be surprised if we see 30,000 quite soon, quite frankly, 50,000. That wouldn't surprise me at all. We are right now bumping up against the all-time highs. In fact, we're marginally surpassed it recently. There's going to be some supply, coming into the market, I suspect. But even here, over the past few days, we've seen any supply got absorbed very quickly. And it does remain bullish. It's a bull market, and one of the most difficult things to do in bull markets is to hold on. So that's kind of what we're trying to do here with this.
All right, Serge, thank you so much for all of your insights, as always. It was great to chat to you.
Thank you.
And that was Serge Berger from thesteadytrader.com talking us through what to watch in terms of US equities into year end and beyond. I'm Victoria Scholar, and thank you so much for watching IGTV.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.